Hi guys. Today we will analyze Dollar General stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a good performer in the overall market. The long and short-term trends are both positive. Strong support levels are around $230 and $219. Next strong support levels are around $204, $188 and $173. Strong resistance level is around $250. Next strong resistance level is around $260. In the last month the stock has been trading between $219 and $251 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 2.4 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 9% per year, for last 5 years. We see that the average profit margin of the stock has been around 7% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 86% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Dollar General Company: bad, average, and good. First scenario. Dollar General will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 6%. Future profit margin would be low, 6%. Future free cash flow to net income rate would be low, 70%. In this case, the fair value of the stock today would be $185. Second scenario. Dollar General will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 7%. Future profit margin would be average, 6.5%. Future free cash flow to net income rate would be average, 75%. In this case, the fair value of the stock today would be $222. Third scenario. Dollar General will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 8%. Future profit margin would be high, 7%. Future free cash flow to net income rate would be high, 80%. In this case, the fair value of the stock today would be $264. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 9.76. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Dollar General, analysts forecast growth rate around 8% per year in next 5 years, and future P/E around 21. Again, I will use 3 different scenarios for Dollar General Company: bad, average, and good. First scenario. Dollar General will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 6%. Future P/E would be low, 15. In this case, the fair value of the stock today would be $105. Second scenario. Dollar General will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 7%. Future PE would be average, 17. In this case, the fair value of the stock today would be $129. Third scenario. Dollar General will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 8%. Future PE would be high, 19. In this case, the fair value of the stock today would be $157. As you can see, today the stock is overvalued, $246, even if we expect the company's high performance in future. The company has a medium financial health, and its profitability is only medium as well. Also, the stock is expected to show a small growth in revenue in the next 5 years, 6 to 8% yearly. Based on that, the stock looks overpriced at the moment. I may consider buying the stock when the stock drops below $180. Company strengths. Dollar General is an American discount retailer that provides various merchandise products. It operates 18,216 stores in 46 U.S. states. Stores sell everyday necessities that drive frequent visits. Dollar General is a retailer that has created a unique business model that revolves around small stores in small, isolated towns with few shopping options. The company's strategy has allowed it to grow aggressively, cheaply and profitably, amidst a broader decline of brick-and-mortar stores. The company has resilient business model and strong cash flow profile. It has various strategic initiatives, including rolling out new store concepts, expanding into Mexico, improving its distribution operations, and upgrading its digital operations. Dollar General opened 1,050 stores in 2021 with plans to open 1,110 in 2022. The company announced a new store concept, P-Op Shelf, and if successful, this new store concept could significantly extend Dollar General's growth runway. Wages for the average consumer are lagging the pace of price increases, driving more customers to dollar stores. About 75% of the products Dollar General sells are under $5. Low prices and average ticket sizes protect the dollar store segment from digital incursion, as shipping costs are difficult to absorb, all while allowing firms to sell smaller package sizes at higher margins. As a result, the company is less affected by competition from Amazon than most of our retail universe. The company's return on assets of 8%, return on equity of 38% and profit margin of 7% are in line with the rest of the industry. Risks. As a discount retailer, Dollar General is contending with myriad headwinds, though its underlying business is holding up quite well. The economy is a risk for all retailers, because of their sensitivity to changes in consumer discretionary spending. Gross margin pressure is a risk. Competitive pressures coupled with an increase in sales of consumables, the product category with the lowest gross profit rate, could put pressure on overall gross margin. Dollar General must balance the need to expand its store count with the risk of growing too fast, which has been a problem in the past. Competition in the retail sector is intensifying, with digital and conventional retailers attempting to meet rising consumer expectations. Expansion into suburban and urban areas exposes Dollar General to greater competition from mass merchandisers, convenience stores and other outlets. The company is not financially healthy enough, and could expect problems in meeting its short-term obligations. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 6 to 8% on average per year. The earnings per share is expected to grow by 10 to 12% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.